All right, welcome everyone. Thanks for joining us here on this Quantopian webinar. We're here today, and we're joined by Song Lee, my compatriot here from Quantopian, and we're also joined by James. Oh, James Crane Baker? Or James Crane? I'm blanking now.
It's a mouthful.
James Crane Baker. Sorry, James. We've only talked on the phone 50 times. And Malik Corbett from Psych Signal. They are one of our partners here at Quantopian. And today we're going to talk about how not only how Psych Signal generates and gathers this data, but then Song will talk to us about how to use that data in strategies, in quant strategies, and specifically how he implemented one and went about implementing a quant strategy using data from Psych Signal on Quantopian. And so we'll have a concrete example for you to work through, listen, learn about, and then hopefully you guys can you can all clone it and try it out yourselves and examine it in detail. It's a great algo to get started with, and hopefully you can take it and run with it. So that's sort of the agenda. We'll of course try to leave as much time as possible for questions. Hopefully you've discovered that question pane down there, and we'll keep tabs on it along the way. We've got 91 attendees.
The questions for me aren't showing up in the question panel. So if I get any questions, you're going to have to repeat them to me.
That sounds good. I will be the I will man the questions from here and play the role of generally play the role of underpaid talk show host. So with that, James, thanks for joining us. Can you just give us like the 30-second overview as to what Psych Signal is all about? Tell us about the company.
For sure. Psych Signal, well, we produce something we like to call trader mood. And it is a very specific kind of financial sentiment. And what we do is we process Twitter and stock tweets, and we are looking for the specific sentiment that traders and investors express online, which is bullishness and bearishness. It's a little bit different than positive and negative neutral sentiment analysis. We built a custom, it took us like years to build a custom natural language processing engine that goes after bullishness and bearishness. So like the specific language of traders is kind of unique. So you need to build an engine to extract that data out, and that's what we've done.
So let me unpack that a little bit. So you know, like for example, with Twitter, you're connecting to the fire hose from Twitter and getting all the messages from them, or are you getting a subset? You know, how do you choose that subset? Like, what's that connection?
Yeah, so we don't actually connect to the Twitter fire hose. We have access to all of the tweets, but we do lots of filtering. So GNIF is the data provider for Twitter, and they have this product called Power Tracks, where you can put in all of these filtering mechanisms. So we have thousands and thousands of different filters in terms of targeting different tweets. Because we don't want like garbage in there. If you're talking about like the iPhone, you're some teenage kid, we don't care about that. But if you're a trader talking about Apple, we care about that. So our filtering in Power Track pulls only those specific messages out. For stock tweets, we pull the full fire hose of stock tweets because we assume everybody on stock tweets is a trader and investor. So it's pretty important. You know, the actual NLP engine is a key part of it, but also the filtering is a key part of this whole process to get this quality signal.
Yeah, how would you like identify me as a trader or me as a trader on Twitter? Is it using like the cash tag where, you know, instead of using hashtag?
So, yeah, like basically without giving away our secret sauce, but yeah, essentially that's a big part of it is cash tags.
Gotcha. And I mean, it's a sticky problem distinguishing between like I ate an apple today and I think Apple is going up. You know, that kind of thing.
Exactly. It is. Yeah. So we're of the mindset of throwing data out rather than including junk in.
And so you also mentioned stock tweets. There's Twitter.
Love stock tweets.
Yeah. Like, can you talk about what's the difference between, in terms of the data that you're seeing there, like do you see sort of differences in the nature of the conversations? You know, is there different?
Absolutely, yeah. yeah, the conversation is a higher level on StockTwits. They also are more of a tight-knit community. And so, I mean, people are talking, generally on Twitter, it's nice, but like StockTwits polices the community. And so they're always like banning people if they're spamming and things like that. We noticed there's like, as soon as there's penny stocks, we don't even cover those, but we notice there's tremendous manipulation on Twitter with penny stocks, and it doesn't occur on StockTwits. And it's because they have a community, and that's to Howard, the CEO of StockTwits, credit for creating that great community. So yeah, it's a higher level of conversation just in general.
Yeah, and I think I'm sure you've talked to the guys at StockTwits. I have too. I think one of the things that I didn't really realize until maybe a year or two ago, when StockTwits first started, they were essentially an application built on top of Twitter, right? And
Correct.
That's not really the case anymore. And I think it's easy to have missed that, but it's its own sort of freestanding social media network now that's explicitly on it.
Yeah, it's just like Twitter, but just exclusively the financial markets.
Right. And is there a different kind of, say, persona, the type of person who's on StockTwits is a little more professional, is a little more is there sort of a different sort of personality that you see there?
It really, really runs the gamut. I mean, people have multiple accounts, so people are on Twitter and they're also on StockTwits. It's just like the level of conversation, because they police it and they have house rules, is better and higher level. Right. And all the tools for for social networking, and they've got like stock price on there. They hooked it up to Robinhood so you can trade. So it's just a little bit more active. I'm excited to see if people actually pick up on the Robinhood and start trading on it. I think that data could be really interesting down the line.
Gotcha. It's funny, we're also partners with Robinhood. We were in their beta program, but neither of us knew that we were both in the beta program together because we were each sort of siloed away from each other. And then that announcement came out, and we were like, oh, hey, we've both been doing this side by side. In more practical terms, what types of customers do you see sort of using your API from a quant perspective? And I know quants are sort of famously, and anybody on Wall Street is famously sort of reticent to share what their strategies are when they're using the data. But what kind of strategies do you think are well suited for use with the data? What do you see sort of the value in terms of a strategy to implement with your data?
So that's a two-part question. So our current clients are these large, sophisticated quant hedge funds. I mean, I can't really disclose who they are just because they don't want, but you know who they are. And so they do all sorts of strategies. I've heard that some funds are running 500 different strategies on our data. I think that, and I'm not a quant, I produce this data, but I can speak to it and tell you what people are doing. And there was just recently the University College London put out a paper where they, you can find it on our website, Signal website, where they are basically looking for non-linear relationships in the data, and that's where they found the low-hanging fruit volatility strategies with the data. And it kind of makes sense, right? Like volatility is something that this low-hanging fruit with this data, because like the whole concept of Signal is like, I was a trader for 10 years. I mean, I still trade, but I was a trader for 10 years way back in the day, and we used this thing called a squawk box, and this was open mic speaker systems that used to connect trading floors. So in our case, we paid this guy to sit in the S&P futures pit and just call the market all day long. They'd be like 5-8, 7-8, taking the offer. I'm struggling with open a glass of water.
Right there, James.
Sorry. Wait, why do you think it's over? I got a cough.
All right.
What? Water is a dangerous substance.
All right, we will hopefully James will come back to us from the attack of the sore throat and the water. Sung, why don't we hop over and see if there are any quick questions as you're drinking water at the same time, power of suggestions. So we've got some questions about...
Sorry. I'm really
no
sorry.
worries. All right, so
I had to mute myself on coughing. Wait, where was I? Oh, yeah. The squawk box.
Yep.
Right? So the roar of the crowd was like, tremendous for us. And it makes a lot of sense that if you're like listening to social media and people start going crazy on social media, it's going to be indicative of volatility. All right? Does that make sense?
Especially if it's reached maybe the sort of the widespread discussion on Twitter, where it clearly hit the sort of the public consciousness, then there's going to be a lot of volatility. It's sort of indicative of sort of greater amount of players, right, in the market.
Yeah, exactly.
Interesting.
Exactly.
So let's, with that, let's shift over our attention to Song. Song here, we here at Quantopian work to integrate that data from SignalSignal into the platform, right? So tell us about sort of the data that we have from SignalSignal, integrated into the platform, and maybe and then we'll go from there.
Right. So we have a couple different data feeds from SignalSignal piped through Quantopian. James mentioned that there is both the Twitter and StockTwits social media source that they derive their bullish and bearish intensity scores from. We have every permutation of each, both the Twitter only one, the StockTwits only one, as well as a combination of both the Twitter and the StockTwits data source. These are all done on a daily basis. I know that some of the other data feeds that James provides on a more extensive level is it's a bit more granular than that. But we provide
1 minute.
Yeah, on a minutely basis. We look at it at a daily daily mode, and for those who are familiar with Quantopian, we pipe it through our pipeline API, which is a pretty new feature that we've released, and yeah, anyone can start using it. We have sample data going up to, I think, January of 2016.
Right. So there's a free sample, and
a free sample,
and then for out of sample testing, you
sample testing, you can subscribe to the data sets for kind of a fraction of the cost that
some of those unnamed
funds are. Given they are doing it at a much more granular level.
Cool. Yeah. So we've got this data. So we've got this post from the forums that you've pulled up. What was the strategy? What was the thinking in the strategy here that you wrote with this data? Like, what data did you use, and what was your approach?
Right. So for everyone on the webinar, if you're looking at the screen right now, I have a post called "Trading Signal Based Off of StockTwits Trader Mood." That's pretty self-explanatory. I used the StockTwits data to create an algorithm that tried to see the effectiveness of SignalSignal's daily data at the most simple level possible. But the thing that's not shown in this post is that the algorithm that I created here is actually a culmination of a lot of different steps that I took to analyze the data before I got to the point where I could create an algorithm, and we can walk through that later. But at a high-level overview, this algorithm, and I'll scroll down to kind of the results over here. It basically looks at the previous day's bullish and bearish intensity levels per security, weighted by the number of messages that have come through. So SignalSignal provides both bullish and bearish scores for, let's say, Apple on a 0 to 4 basis, 0 to 4 score. Now that can be, I think, it's a continuous range, so it can be both decimals. It's decimals, so it's not like multiple stocks can have the same score. And you also are provided with the number of messages that have come in the previous day. So like James talked about briefly.
Does that make sense?
Huh?
The number of messages is just, regardless of whether we can, so a message will come in and we will see if it has bullish or bearish sentiment in it.
Right.
But regardless, the total message count is still interesting too. So if you think back to like the pit analogy, total messages is just like, is the pit full or empty? And then the intensity score is like, is the pit, screaming very loudly bullish or screaming very loudly bearish?
Right, exactly. So I guess so going off of that, there are three actual kind of like message number scores. There's a number of bullish messages, number of bearish messages, and a total number of messages scanned in order to get those, in order to get the subset of that, which is a bullish and bearish. I only looked at the bullish, total number of bullish and bearish messages here because I wanted to weight it by the sample size that went into determining kind of the quantitative bullish and bearish intensity levels that Psych Signal provides. But yeah, going back to the strategy, it looks at the previous day's intensity levels. It weights our portfolio looking at the top bullish securities and the most bearish securities, going long on the bullish and going short on the bearish. And obviously this algorithm is mainly trying to analyze kind of the effectiveness of the symbol of the signal, and you get actually pretty consistent and good results, especially if you were to enter this into, let's say, the Quantopian contest. Just looking at the risk metrics, returns over the course of 2 years, average annual returns of over 10%, drawdown is super low, volatility is super low, and Sharp is very stable at 1. So
I mean, there are sort of two elements there to those risk factors. One is there's the alpha signal that you're using, which is the data from Psych Signal, and that's helping you to create. Let's make sure I understand it. That's helping you to create two buckets, two books, right? A long book and a short book.
Yep.
Right. So you're going long on the bullish stocks and you're going short on the bearish stocks.
Yep.
There's sort of a future sort of predictive power of the stock.
Yep.
And then you're getting some of that market neutral through the construct of a long short algorithm.
Right. Exactly.
Okay.
Yep.
And then sort of how explicitly are you, like, can you walk us through the explicit steps that you've taken to access the data to build those long and short books? Like how do you do that in Quantopian?
Right. So you've been through the backtester,
Sure.
The code.
Yeah, look through the code. Yeah, definitely. How, like, if I wanted to go do this myself.
Yep.
How is this happening in the code?
Yeah. So for those joining us on the webinar, if you have a Quantopian account, and I suggest everyone open one, you can go to our community page. You can see that people are sharing lots of different strategies and research that they've done. Mine is on the top page over here, trading signal based off of StockTwits Trader Mood. You can actually go down and clone the algorithm for yourself. So you'll have all the code that I use, the backtest states that I've used, the capital base that I started off with, and you can get started working with it right away. Once you do that, you'll be taken to kind of the development environment. It's kind of code heavy, so I won't walk through every step of it right now, but I'll show you the main parts that I was talking about briefly before. So within Quantopian, and especially within the backtester, we are focusing on this concept of developing factors. Now, Josh mentioned that I was using Psych Signal as an alpha factor. So in that case, I'm using that to generate my signal to trade and determine my long and short books on. If you expand that, you can also add risk factors for you to, let's say, not trade when there's an earnings announcement, et cetera, things like that. But you can see here that I have two kind of alpha factors defined at the top. The first is simply the bullish and bearish score that I was talking about. So this is looking at yesterday's bullish intensity levels minus the bearish intensity levels over a one-day period. I used this later on, weighted by the number of bullish and bearish messages to determine my long-short portfolios. And actually, looking at my universe of securities, I'm actually only looking at the top 500 securities with the highest number of bullish and bearish messages. So from a lot of the research that I've done, you can see that different securities have different amounts of coverage. For example, Apple is going to be much more popular on both Twitter and StockTwits than some random oil company based out of, I don't know, San Antonio, Texas. You know what I mean?
Sure.
So I use, when I say weighted by the number of messages, I'm actually talking about, I'm defining the universe of securities that I'm looking at by the 500 stocks with the most amount of both bullish and bearish messages over the past 30 days. Because obviously popularity and trends could change over time, and I want to have a fast-moving universe ranking, but at the same time something that's not going to be so noisy as to change turnover every day.
So you're creating what's known as a custom factor here for use in our pipeline API.
Yep.
You say for the messages, at least, you say you want a window length of 30. So you're going to look back and essentially build a table of message counts for each security
Yep.
on a daily basis going back 30 days.
Yep.
And then in that compute function there inside the psych signal messages class, which is the factor that you're defining, you are, let's see, so, and then
I'm just taking the average number of messages.
Just doing the average count and using that later on when you build your pipeline, you're using that as a filter.
Exactly. Yep. And you can see that down here. I'm saying, well, pipeline, you attach the different alpha factors that you want to use in your algorithm. And you can see down here at the bottom that I'm using the filter that Josh was just talking about. I'm saying pipe dot set screen. So look at all the securities within the universe and screen out all the ones that don't meet this specific criteria.
So in this case, we actually have two criteria. You've also put in a dollar volume criteria.
Right. And yep.
And you're looking for anything with more than, you've ranked them based on that.
I've ranked all the securities within the universe.
And you're taking the top 100. And you're taking the top 500. So we create this pipeline in the initialize function. At the very top, we say pipe equals pipeline, paren, close paren.
Yep.
And then we attach the factors that we've created. One of them is the sentiment. The other one is this.
So I'm only attaching my psych signal factor.
Oh, okay.
And then I'm just screening out everything else
based on everything else.
Yeah.
So that sentiment factor, let's go back and sort of figure out how that was built then. So it's built in a similar way, right? We've got a custom factor as this class, and then we're not using window length of 30 this time. Now
we're just looking at the previous day's bullish minus bearish intensity levels.
Because we think we want to act quick.
We want to act quick. And this is kind of not only did I want an algorithm that acted quickly, I wanted to create something that would serve as a good template to expand upon.
Okay.
And by limiting my exposure to just the previous day's signal, what I'm doing with my algorithm is saying, look at the baseline for how the stock market would react to the signal without a lot of complicated quantitative math put on top of it.
Got it.
So what are you working with just off the bat? And that's what I'm looking at.
Right. So this is a very simple. So you're saying
you've
got a simple template.
Yeah, very, very simple.
You could probably improve the logic here. You
could hopefully, definitely.
Pursue some of the volatility ideas, right?
Exactly.
Those sorts of things that James was talking about.
Exactly.
With this as a starting point. This is a pretty good starting point.
It's a good starting point. It's a very good starting point.
Okay, cool. And then
finally, before so I'm determining my long and short books by taking, by looking at my ranked universe by my bullish and bearish scores. So I'm ranking each security. The top ranking security is going to have the highest bullish intensity levels, and the lowest ranking security is going to have the most bearish intensity levels. And I'm separating that ranking into percent quantiles. And I'm taking the bottom 5%, which is my most bearish securities, and I'm taking my top 5%, which is my most bullish securities, and I'm determining my long and short books from that.
Okay.
And you can see that here where I'm saying get the results of my pipeline, and my pipeline is defined down here. Get the results of my pipeline, get the top and bottom 5%, and determine my long and short books from that.
So so you filtered it down to 500 stocks.
Yep.
And then you're taking the top 5 and bottom 5% of those about
Right.
500.
Yep.
500 sort of set of stocks. So you'll get
50 securities.
50 securities overall, 25 long, 25 short.
Exactly.
And then off you go. And then you've also built in a dollar volume filter in here as well, and that's, I think, presumably that's a protection just against sort of excessive slippage in the simulation, and
right.
and going after illiquid stocks that are going to have a major, slippage is a change.
Exactly. Yeah.
Your behavior changing the
price of the security on the markets. Yep.
Okay. So you by keeping it focused on some of the more liquid stocks.
Right. And I actually did two things here. When a common mistake that I've seen a lot of Quantopian users do, and especially, I've done this mistake plenty of times, is create an algorithm, a starting algorithm that it's not going to be practical for you to keep building on. So if you're starting your universe with illiquid securities, then whatever trading strategy that you're coming up with later on is probably not going to be practically executionable for you. You can't execute it later on to actually either enter the contest, make money off of it, whatever.
Yeah.
Right.
The simulation results are going to be whether or not there's alpha in there.
If you can't trade on it, then what's the point?
Yep.
So I do two things. So I mentioned that I'm ranking all my securities by the number of messages. That ranking is within the top 1,000 securities by most liquid, the top 1,000 most liquid securities, and I'm looking at the message rankings in them within that kind of pool. And I'm also filtering out any stocks with an average dollar volume of less than 10 million, average daily volume less than $10 million for the past 20 days.
In terms of sort of the volume of trades.
Yeah, the floor of like how illiquid can the security be.
Gotcha.
Yeah.
Gotcha. So, so you run this through. Did you actually run it through Pifolio or not? Do we have those results?
I don't have Pifolio up right now.
So Pifolio, just for we didn't run it. I guess we didn't do it. But Pifolio is our open source risk library.
Yep.
It's a set of essentially a library that's accessible in research that lets you do deeper analysis on backtest and live trading results.
Yep.
So tell me how...
We could do that right now, actually.
Whatever.
Leave it as an exercise. Leave it afterwards.
We can follow up the post with that.
Yep.
So this all seems pretty logical as you explain it here, but there's a lot of work to get to this sort of simple algorithm. Like what was your process to build up to this? Because you didn't just sit down and write this algo. You did a lot of research in advance of that built up to this algo.
Yep.
Walk us through some of that work. I know you've published some of that, but walk us through some of that work.
Yeah. So in a webinar that we did with Vinesh, who's one of the researchers for Estimize and one of their advisors, we asked him, hey, what do you do as a pro, as one of the top quants in the world?
Right. So he worked at PDT. He worked at Starmine. He's worked as a quant on Wall Street.
Right.
And no longer does that, but he has walked the walk. He's done it professionally for about 10 years.
Yeah, he's basically like as good as you're gonna get in terms of like how do you work with data and what's the process that you do for that.
Yep.
So we asked him, hey Vinesh, like what I'm not a quant. I want to learn how to do this stuff. What do you recommend is kind of the process that I iterate on? And so he kind of broke it down into 5 different steps. And I kind of took that through with SignalSignal in order to get to kind of the algorithm that we were just looking at. And especially for those who are looking to work with data, this is super useful. And I found it to be a much more systematic and methodical way of working through algorithm creation and data and trying to get alpha from data. So the 5 steps are pretty simple, and I kind of laid it down in a research notebook that I published on the forums. And for those who are interested in getting to this content, we will send out an email after the webinar with all the stuff that you've seen on the webinar today. But the 5 steps are pretty simple. First, whenever you get a new data set, you want to examine it. You want to just kind of take a look at what's the coverage, how does it change from year to year. For example, with SignalSignal, my main goal was to see do different sectors have different coverage? Do different liquidity baskets have different coverage? The answer is yes, different sectors have different coverage. You get more coverage as the liquidity gets higher, et cetera, et cetera. The second step is to set up your environment and set up your universe of securities. So in here, you kind of want to define what's your minimum level of liquidity, what's kind of the universe of securities that you're looking at. And that's where I got my floor of average daily volume, average dollar volume of 10 million for the past 20 days. After you do that, then you want to start kind of coming up with a list of hypotheses that you have for the data. And this is kind of, basically you can see the first 2 steps as observation. And after you've done enough observation, you want to start heading towards making kind of guesses upon those observations. So I looked at how message coverage differed by liquidity and sector, and I used that to weight my securities, as you saw in the algorithm.
And this is where I think a lot of the heavy lifting is happening, right?
Yeah,
exactly. You're iterating through a lot of hypotheses,
right.
You've got some ideas, but you're still not actually writing a strategy and doing backtest.
Yeah, exactly. Yeah, exactly. And only after you've done that is where you kind of start getting into writing your strategy and doing your sample testing. And that's where kind of the back tester comes in, and that's the algorithm that you've seen. So it was a lot of different steps that I took to get to kind of this algorithm that seems really simple on the surface. But if you look deeply at the process involved to get to that point, it was actually it was actually a pretty a labor-intensive process, which hopefully many of you won't have to do because I've done it all for you.
All right. They can clone the algorithm.
Yeah, you can clone all my work
and tweak it. And of course, the important out of sample testing is yet to come.
Exactly.
Well, that's awesome. So, Song, if you had sort of ideas as to like what you would want to do, like no algo is perfect, and this is definitely like a starting point algo.
Yeah.
Like, what are some of the ideas that you think you'd want to explore next with this algorithm?
You know what? I think from this point, just hearing hearing kind of what James talked about as using SignalSignal as a measure of volatility, I would play around with using it as a risk factor almost, looking at different periods of volatility, seeing if that would affect, for example, if you had a momentum strategy going on, you could see the correlation between the momentum signal and the SignalSignal factor that I've shown you in this algorithm, and see if I can create some sort of mix between the two.
So if I want to take this algorithm next step, I'm a user. I go to the forums, I clone the algorithm, and then what do you think? What do I do inside this algo?
You know what? Maybe added extra pipeline factor. We have a lot of examples for different momentum factors on pipeline. I would add a new one, go here and try to play around with different weightings of the 2 factors. For example, we have the SignalSignal factor. If you had a momentum factor in there, you would say something like, take my SignalSignal factor, give it a 50% weighting, take my momentum factor, give that a 50% weighting, and use that to determine my long and short books.
Sure.
Something like that.
Awesome.
Yep.
Awesome. And just just to remind folks, if they want to access this data on Quantopian, you have sort of a long sort of time frame for back testing.
Yep.
You can back test as many times as you want.
Yep.
There's a free sample, and then there's a sort of a window of time that is blocked from use, and that's reserved. That sort of out of sample block is reserved for the subscription fee. So
Yep.
you can get started with all this without paying anything. It's all free.
Yep.
Until you want to do the out of sample, and then once you're sort of at that sort of fourth,
if you're at that point, then
those 5 steps that the 5 steps that you outlined, pretty much the first 4 of them you can do with this free sample data set, and then once you're comfortable with it and you want to take it to the next level to do that out of sample testing, that's when you buy the subscription, and you can just you can access it all there in the data menu here on Quantopian.
Exactly.
So let's dig in. I think that covers the first 2 pieces of our agenda. Let's jump into some of the questions here and see what folks have. So let's give me 33 seconds here. Let's see. So here's a Giancarlo asks, and I'm not sure how much James and Malik are gonna give away here, but they say, hello, do you use agent-based models in order to quantify the mood in Twitter, and presumably also in stock tweets? How do you know what keywords to search?
That's kind of giving away a way to see yourself. We use a linguistics-based approach to building our natural language processing engine. I don't really want to get too into it.
Totally
I'm trying to answer the question politely, but it took a long time to build this engine, and keywords were the start of it.
Yeah,
Right,
I mean, I've got sort of experience myself in a previous life with natural language, a lot of natural language stuff, and there's an element of it is the technology, but a lot of that technology is relatively well known. The special sauce here is the effort that companies like SignalSignal put in to sort of annotating the language and understanding the language and codifying that, through a lot of hard work. Through a lot of hard work sometimes, right? There's and doing some
data categorization and filtering, and it just took a long time, and it's just a lot of hard work put into it.
So,
but I will say it's a linguistics-based approach.
Yeah, exactly. All right. So Bjorn asks, will this be available later as a video? And the answer is definitely, for sure, yes. We will. We're recording this right now, and it will be posted to the Quantopian account on YouTube, and we will likely.
We're gonna send it out.
We'll send it out
as a follow-up email.
There'll be a follow-up email for all registrants of the webinar, and you'll get a link to that account. Let's see. Anand asks, when you say messages, is it market news or buy-sell signal? So I guess maybe James has a different answer. I think what he's asking here is like where are these messages? And I think these are any messages that are coming through from Twitter or from stock tweets, and it sounds like SignalSignal is filtering down these messages and analyzing the language. So there isn't necessarily a buy or a sell flag set on them. I know, or bearish and bullish signal from stock tweets that they're using. They're analyzing the language, regardless of how the data's been flagged explicitly by the vendor or by the user.
Correct. A message is just a tweet, and on stock tweets, like you said, you have the ability on stock tweets to tick off a box on bullish or bearish, but we don't go by that. We go by the expressed language, and it's mostly because you're sitting in a crowd and you're expressing yourself, and then that bullish or bearish sentiment propagates throughout the social network.
So here's a question from our friend Jim, the friendly troll from before during our pregame show. Do you think tweet sentiment factors are more important than the Pharma French factors?
I think that the answer here is it's one of those like apples to oranges comparisons, because they're so different, and the exposure of one is obviously much different than the exposure of something else. For example, Fama French is like this bedrock of quantitative finance. It's kind of like Fama French is basically like it's three types of, I think it's like three types of alpha factors that are used to kind of classify securities, and they're kind of like the bedrock of quant finance, especially in terms of like factors. But tweet sentiment factors are so new, and really it's kind of cutting edge technology, and it's hard to say whether one's better than the other, right? Because one is, I mean, they're just two totally different things.
All right.
Yeah.
Generally, what is the rate of signal degradation for this sort of daily data, right? So the data that we're putting in from PsychSignal is daily in nature. The signal, the algorithm harness, the algorithms themselves access it on a daily basis. What's the rate of signal degradation? Is that something that you looked into with this yet?
Looking at it on a monthly basis, unless there's like a significant change, I mean, it's hard to say. I think.
I mean,
yeah.
I mean, you have you've got that event study template notebook.
Right.
We didn't run it through that.
We didn't run it through. We could look at it.
We could look at it from that perspective and use this as a you could use it through the lens of an event study to see what when the signal dies out from that perspective. But it seems like we didn't.
Well, it's different because you're asking kind of like if does yesterday's signal matter 7 days ahead versus does the past month's signal matter in long-term strategy. I think it depends on what kind of strategy that you're looking for, and being able to test between what'll fit for you at that point.
Let's see. Are there any other questions? Oops, how frequently? Oh, go back down.
Sorry.
So, there it is. How frequently do you update your engine to segregate bearish and bullish messages? Do you test before release to make sure the changes do not impact downstream consumers? So I guess
every iteration of the engine is versioned. So right now we're on version 4 of the engine, and we let our clients test first. We don't just change it. We don't change the underlying engine at all.
Gotcha.
If we change it, you'll know, and it'll be a different data set.
Right. Essentially with a different historical data set to test off of and to simulate against.
Exactly. So with our clients, it's like our job to sell you on the new data set. Say, okay, you're on version 1. Let's go to version 2. Well, then they do their testing and say, yeah, we like this better. So the only thing that we do is we try to control people's spam. So that's something we work on in the engine, but that's about it.
Yep. So a question from Isaiah: how do you view the data? Can you graph report it whatsoever? I think the answer there is, the data is actually available on Quantopian in 2 fashions. One fashion is as Sung sort of demonstrated here through our pipeline API, and that's how you access the data inside an algorithm. If you'd like to research that data, interact with the data, graph it, sort of look at it, it's also available on our research platform. And so you can go in, and if you go find and maybe you can go plot it with the built-in plotting libraries here in our IPython-based research platform. If you actually go, Isaiah, to the data menu, and so maybe hop over to data and show, there you go. So if you hop over to data and then click on one of these PsychSignal data sets, oftentimes you'll see an example notebook. And if you click on that, that'll walk you through the basics of sort of getting familiar with this data and sort of analyzing and interacting with it in an ad hoc manner as opposed to in an algorithm. So you can see it, chart it, look at it. You can look at some of the charts that I've done when we roll out these data sets. So a question from Francesco is, do you think that that PsychSignal data is optimal for a pairs trading strategy, or do you recommend other trading strategies?
I think it'd be great for a pairs trading strategy. The technology is so new that I think there's so many options that you could go with. My initial jump was to go for a momentum strategy. That the signal there was pretty good, so I think there's a lot of ways.
Yeah, but yeah, I think sentiment. You know, the underlying logic behind a pair trade is that there is some short-term volatility or discontinuity between two stocks that typically track together or typically are co-integrated. And so if you can, I like definitely sort of sentiment or the mood of the crowd, of the trading crowd, can definitely work as an input into a model to help identify those discontinuities. If you're interested in digging in further, I know that the Quantopian lecture series has great content as to how to identify pairs and how to build out a pair trading strategy. And you can sort of merge or sort of take some of the approaches or sort of methodology that is sort of taught in those lectures, and use that with this data. Sort of combine this little research or this little example notebook for accessing the data with the pairs trading lecture, and I think you might you could be on the path to a novel strategy yourself. Let's see. So there was the 500 securities with.
I have the number for. So Nick Kirk is asking, what is the average number of tweets per day per security? Looking at the 500 securities with the highest message coverage.
So we don't actually know that off the top of our heads, but if you go, I can teach you how to fish here. So Song, if you scroll back up, you see, in this research notebook, you can go all the way to the top. There we go. So I mean, these counts are available in the data set, so you can start to make that calculation yourself, right? In that case, we were sorting this sort of message here. We're seeing a couple of securities with just a couple of messages, but all that data is there for you. So we might not know it off the top of our heads, but you can definitely do some simple Python to get that average count. Let's see. Let's see if we have any others that we can answer. Maybe scroll back up. All right. I think that's about it here. So I want to nope. Oh, the three fundamental alphas. So Gailey is asking about the three fundamental alphas. This is from your discussion and answer on the Fama French factors.
Oh, right. So, we actually do have a post on that.
Do we have? Oh, that's right.
Do, yep.
We have a Fama French post from last summer from John Lober.
Yep.
So if you go into our community, we were having a discussion about the Fama French factors. And one of our intrepid interns from last summer
created a notebook called Computing the Fama French Factors with Pipeline.
So you can definitely check out this notebook as a start for working with these factors here on Quantopian.
Yep.
They're also made a part of the analyses that are made possible in PyFolio, yep. Which is also easily used on our research platform. And then, it's a very common, I am sure that you could go, I think, oh, well, there you go. The link is right there. That probably takes you to some of the, all right, so it takes you to Wikipedia or some other
explanation.
But it's a commonly sort of well-known sort of set of concepts in quant finance that's pretty well documented and distributed worldwide. So a little Googling will get you there. And I think with that, we will wrap things up. We're at about 5 minutes before the hour. So James, Malik, thanks for joining us today. We appreciate it, everyone.
Thanks for having me.
thanks for joining us. We appreciate everyone's attention. It seems like pretty much everybody stayed on through the hour, so we want to thank you for spending an hour, spending an hour of your day with us here. We've recorded this session, so look for the link in that follow-up email, and look for links to much of this supporting content here in the Quantopian community. If you like some of this, we do these webinars on maybe once a month or so, every couple of weeks, once a month. We put out a webinar like this. Also, this coming Saturday, we have our annual conference coming up. There will be six parallel rooms. Yep. With talks. I think as of this morning there is one ticket left in person. So there might be one ticket left if you want to join us live in person in New York. You can shake my hand and say hi. If you can't make it to New York but you're still interested in QuantCon, there is a streaming option. And you can purchase a ticket for the live stream. The live stream ticket also gets you access to the presentations afterwards. And that ticket is there's still lots of tickets available for that. And all proceeds from the stream are donated to code.org, a charity that here at Quantopian we like. So hop on if you want to spend Saturday with us and some incredible speakers. Some incredible speakers. They'll all be in New York at QuantCon, and you can get a streaming ticket for that. So with that, I want to thank everyone again, and everybody get coding. Try out and clone that algo. Thanks a lot.
Bye.
Bye-bye.